Hi, everyone. Today we're going to work on talking about life insurance, some of the advantages, the disadvantages, why people buy them, what kind there are, that kind of stuff. So the first thing is we have a lot of terms, but let's just talk for a moment about why people buy life insurance. And the idea is that if the unfortunate happens and that somebody dies unexpectedly, or they live a very long life and they die when they're much older. There's always a financial cost, whether that be funeral services, unpaid bills, cremation, whatever. There's a financial cost. So a lot of people want to protect their families and their loved ones by providing some kind of financial protection. So that is what life insurance does. It provides benefits or cash to people who the insurer names as a person of chosen to get the money, and they pay for the bills. They may have to pay for a house if they're young, provide for the families, so on and so forth. So there are advantages to purchasing life insurance. And I personally think it's a good thing. It's something that you should consider when you're not just older, but also when you're younger. All right, so we have some terms about life insurance that we're going to look at, and then we're going to look at different types. So, first of all, remember I said that the money goes to somebody, and that's called the beneficiary. It's a person chosen by the policyholder whose name is on the life insurance policy and receives the benefits of the policy after the policyholder's death. Okay, so this is the person who gets the money and disperses it according to the policyholder. Now, the premium is how much the policyholder is paying for the policy. Now, this may sound a little, but the mortality table is the list of death rates according to age group. So it's about what is the percentage or probability that at that particular age that someone dies. And then the rate is the rate for which the person's age group. And the face value is the amount of coverage that the policyholder policy provides. So a person can buy something maybe $10,000 worth of life insurance. So that's how much it's worth when the person dies within a certain amount of time. They can buy $250,000. They can buy it for 5 years. They can buy it for the life, term policy. They can buy a whole life insurance. So there's many different types, but this is how much it covers. All right. So there are, like I said, many types of life insurance and parts of that. So term life insurance is a type of insurance that provides protection to the policyholder. Term insurance covers the policyholder for a specific amount of time. So there is a time limit on this, anywhere from 5, 10, 20, or 20 years. After the time, the policy is no longer in effect unless it's renewed for another term. So in term life, you can say, I want life insurance for 10 years, and you're great, you don't pass, nothing happens. So you kind of paid for this insurance that doesn't get used. It's like buying car insurance and never getting into an accident. All right. Group term life insurance is life insurance that employees get through their employers. So there are some employers that offer life insurance through their company, and they do it as a group. So all employees have that particular life insurance. So there's also what is called level term insurance. This is a type of life insurance that pays the same death benefit over the term of the policy, and the premiums are usually remain level throughout the term. So in other words, they don't increase. They don't, it's not gradual, like at year 1, you're only going to get $5,000, and year 5, you're going to get $10,000. Okay, I have that twice. I am sorry about that. All right, increasing term life insurance is a type of life insurance that pays increasing death benefit over time. So as a result, it has a lower premium than other types of life insurance. So maybe in year 1, you may get $5,000, but you're only paying $50 a month, but in year 10, you may get $250,000 and you're paying $25 a month. Permanent life insurance is an insurance policy that covers the buyer for his or her lifetime or to a specific age. Types include whole, universal, and variable. Okay, so that's what we're going to talk about next. The cash value of the investment portion of a whole life insurance is called the cash value. So whole life insurance is a little different. And why is that? Okay, so whole life insurance, and I apologize, that is not on our list. So let's put that in here. Whole life insurance is a policy that combines life insurance with an investment. So you pay a premium that's divided between your insurance and investments, and they have a cash value. So in other words, the insurance company invests part of your premium into stocks, bonds, whatever, so that you may get a higher value back. Okay. As you get older, more money goes into the insurance component and less into the investment component, unless you change the death benefit, unless you talk to the insurance person. Okay, so if the policy cancels the insurance before death, they can receive the cash value, but the insurance part is not in effect anymore. So in other words, let's say you have it for 20 years. At the end of 20 years, you're still alive and going. Then you can cancel the insurance and then get the cash value back from the investment part. Universal life insurance is similar to whole. Okay, there's a cash value can be used to pay the insurance premium if the policyholder doesn't pay it. So in other words, I can't pay my life insurance. I can use the cash value part to do that. But if cash value is not enough to pay the insurance, the policy can lapse. And then you have variable life insurance. This combines the insurance part with a variety of investment components that may include stocks, bonds, money markets, one of the riskiest. So they will invest, but it's going to be pretty, especially if you do that right now with the stock market being as crazy as it is, you might not get your full cash value back. All right, so let's take a look at some problems involving our life insurance. So we have Jack here, and he's 40 years old. In 10 years, his house will be paid off, and his daughter will have completed college. He wants to take out a 10-year level term insurance policy. Okay, so remember we talked about that. And with the face value of $750, $1,000. The monthly premium is $76. What will be his total cost at the end of the 10 years? All right, so since this is based on monthly premiums, we have to figure out how many months there are 10 years. So let's just do 12 times 10. We're getting 120 months. And then we're going to need to take that number of months, times it by the monthly premium, and we get $9,120. Okay, so that's how much his policy will cost him over the 10-year period. Okay. So now we have Logan, who purchased a whole life policy with a face value of $100,000 when he was 28. The annual premium was C dollars. Okay, so we don't have an amount here, and that's okay. We can work with that. He wanted to increase the face value to $250,000. So they made him apply to a new policy. Since his current age is now higher, and he has some health risks more so than he did when he was 28, the premium is going to increase to X dollars. What is our percent increase? And we're going to represent that algebraically, which means we're going to have a little formula here. All right, so since he has a new policy, a new amount, that's considered the new value. And we're going to need to subtract the original value from that. Okay, so that is going to be the increase in premium. And what we're going to do then is divide that by the original cost of the premium, which is C. We're going to need to times that by 100 to make it a percent. And that's going to be our formula for percent increase. Okay. All right, so in this problem, we have Gabriella, and that we're going to use this formula to help her find the percent increase that she's paying on her policy. So Gabriella's whole life premium increased from $123 to $166 per month when she increased the policy's face value. We need to figure out what the percent increase is. Now, again, we have this formula, but the way I remember it is it's always the new value minus the old value divided by the old value. So our new value is 166. Our old value is 123. We're going to divide that by 123. And then we're going to times that by 100. Okay. So that's like 34.95 and some change. So let's round this to 35%. So she's going to pay a 35% increase. All right, so Mario has a universal life policy with a face value of $250,000. The current cash value of the policy is $8,260. If the premium is $97 a month, how many more months can the cash value be used to pay the premium? Okay, so he's not going to pay the premium. He's like, you know what? I have cash value in there. I'm going to use that to pay for my insurance. So he's not putting any money of his own into the life insurance policy. So what we're going to have to do is we're going to have to take that $8,260 and divide that by the $97 per month. Now, once we do that, we're going to get 85.15164. Okay, now that's number of months. Well, that does not make any sense. How can we have 81.15 blah, blah, blah months? We can't. So what do we do with that? Normally, our traditional rounding would be like drop it down and make it 85 months, which would be the correct answer. But we're not rounding. Okay. What we're doing is what is called the greatest integer function. And basically the definition is that it is the number that is the largest integer less than or equal to that number. So basically, it is the largest number up to, but not up to that number. Okay, so my largest integer is 85. So there's notation here, and that's these brackets. Okay, looks like this. All right, and that tells us to do the greatest integer function, or basically just lop off the decimal, and we're going to have 85 months. Okay, this is used in real life, like your cell phone bills. If you go over so many seconds, they're going to charge you per minute. So things like that, it is used out there. Okay, so sometimes it's the up to the integer, sometimes it's the integer right after the decimal, depending on the problem. All right, so Joe is an insurance agent, and Zach, a 45-year-old man, talks to him and inquires about a life insurance policy. How can Joe assess the risk his company is going to take on when they offer a life insurance policy to Zach? Okay, so there's this chart here that I could not fit. All right, basically, this chart is called a mortality table. There's one for male and there's one for female. And basically, it lists the exact age, the probability of death, and the life expectancy. Now, what we mean by death probability, that basically means that they looked at many thousands of people at that particular age and determined the probability, right, which is the number of deaths over the total, just basic probability, and determines that is the probability that person's going to die at that particular age. So we have Zach here, who's 45. Here he is. So his probability of death is 0.003732. Okay, now that's in decimal form. So let's change it to a percent, times it by 100. So the probability of Zach dying is 0.37%. That is less than 1/3 of a percent that he is going to die. Okay, so his risk is very minimal to sell him a policy. Okay, now what do I mean by that? Let's take a look at this problem. So we have the Umbrella State Insurance Company sells a 5-year term insurance with a face value of $150,000 to a 41-year-old man for an annual premium of $648. Now, according to this, he's got a probability of 0.26% of dying. Okay, now, why do I care about that? Because he's going to pay $648 every year. Now, if he dies, the insurance company is going to pay $150,000 to his beneficiary. If he doesn't, they're going to make money. If he dies, then they're going to lose money. So basically, the death probability is basically the probability that the insurance company is going to pay the beneficiary. So let's look at this. So if he dies in year 1, he's paid $648. That's how much the insurance company gets. But then they have to pay out $150,000, which means the insurance company is out $149,352. They only made $648. They paid out $150,000. So if he dies in year 2, they got 2 times 648. They paid out $150,000. So they actually paid $148,704. Let's go to year 3, because remember, this is a 5-year policy. So they did 3 times 648, paid 3 years, but then they had to pay out $150,000. So they ended up losing $148,056. In year 4 of the policy, they got 4 years of $648. And he passed away, so we have to pay out the $150,000. So they lose $147,408. Now the policy is only year 5. Okay. So again, if he dies, they're going to have to pay out the $150,000. So the company is out $146,760. After 5 years, the policy is terminated unless he renews it. Okay. So that's if he dies. Well, suppose he lives. He doesn't use the policy. So he paid 5 years of $648. So the company doesn't pay anything out, but they gain $3,240. So is it better for the company? Yeah, because the probability of him dying at 41 is 0.26%. So the odds are in their favor. Okay, the probability is in their favor. Let's take this a step further. So here we're going to go back to talk about Zach here in or a 41-year-old man. And it seems like the company takes on a great risk when they sell a policy, right? They're going to lose money. They're risking it all. But the mortality rates and the amount of profit that are shown in the table below, if the company sold 10,000 of the same policies, what would their expected profit be? In other words, they did the same thing. They had 5-year policy. They were all the same amount. How much money are they going to make if they send 10,000 policies? Well, let's look at this. So what we're going to do is we're going to take and do what is called expected value. And basically just means that we're going to find out what is the average or what should they expect to happen. And the way this is going to work is we're going to take the profit times the probability for every single one of them. So they lost $149,352 times 0.0026. Okay, so that's how much money they had to lay out if somebody died at age 41 in this 5-year policy times the probability that he's going to die. Plus, and we're going to do the same thing, times the probability that they're going to die at age 42. Plus, so we're going to add these multiplications together. Yes, it is a little time consuming to write out. Okay, now the last one is $3,240. That's how much they gained. Like, if nobody died, this is how much money we made per person. And the probability of that happening and nobody dying is 0.9843. Okay. So we're going to multiply them, and then we're going to add them all up. And we get $866.40. We're going to round to 40 cents because it's money. All right, so they expect to gain $866.40. If that was negative, they would lose. All right, now notice the probabilities. I just want to point out that if we took all of these probabilities here, okay, now remember, probability is something that's always between 0 and 1. It can be written as a fraction, decimal, or percent. They're going to always add up to 1. So those guys in the last row should always add up to 1 because that's one total group. All right, then the last part of this question says, what would the expect profit be if they did 10,000 policies? Well, if $866.40 is one policy, let's take $866.40 and times it by the 10,000 policies that they wrote. And they should expect to have $8,664,000. That's a lot of money. Okay. All right. Let me know if you have any questions, guys. Remember, to stay in means that we're keeping everybody safe. Have a great day.